Right.
But you're lucky because I have reactive strategies. So I just did that for somebody in Wisconsin. I saved her 2.5 million on that sale. And now we're going in reverse order. So I did some reactive planning, saved her money. And then now we're putting the trust together. But I took the 7 million, I allocated it in a bunch of investments. She said she wanted like 250,000 of income off the investments to live. I generated a portfolio that's 700,000 a year. And then I put her in some IPOs, some really cool things that are going to just boost that wealth up. And now we're taking all those investments. We kind of went in reverse order with her. She sold a property. I did some tax planning to mitigate tax. I did all the investments with the liquidity event. And now we're doing the trust, and we're just going to move all the assets into the trust. So it's kind of the reverse order. So I can really do it either way. It just depends on the situation. But people typically don't think about tax until somebody's faced with a $3 million tax liability. And then all of a sudden they start looking for people like myself.
Yeah, that's a really good case study. Really quick follow-up question to that. So let's say in the event that, like, I'm assuming in that case, it was a commercial property, right, owned by a business. Is this the right call or another call, or can you speak a little bit to what happens when you personally own high value property? And is there any strategies to move that into a business, prior or into a business trust or a personal trust prior to a sale?
I mean, that's what most CPAs and kind of the standard tax planners will always advise you to own real estate in like a LLC or another entity for tax advantages and write-offs and whatnot. It's pretty rare for me to see people owning significant amount of real estate or commercial real estate personally. It's pretty rare. I don't know many people that I've run across that do that. But if you can transfer that asset into an entity before the sale, that would be smart. And then the case study I just went through, she owned that in an LLC. So what we did is I used a partnership K1 loss at the business level to actually offset that 2.5 million in tax. And it's really good that she owned it in an LLC, because the way partnership law works and these K1 losses, there's limits on the personal tax return for a K1 loss. But at the corporate level, LLC level, there is no limit, right? So we were able to get her a bigger deduction because she did actually own that piece of real estate in an LLC.
That's awesome. That's a great question, Bianca, because I think you're basically teasing out a whole bunch of other stuff, right? In terms of like what to do, now versus later. I mean, and by the way, that example, I just realized, like, oh my God, like I got to make that move too. So thank you, Adam, just for a real estate move.